The AI boom isn't just a technology race, it's a borrowing race. And for investors, that changes everything. Artificial intelligence is forcing companies into one of the largest capital spending cycles in modern history. Training models, running inference, and scaling globally requires data centers, power, chips, and connectivity. This isn't software spending, it's industrial-scale investment. And even the most profitable companies in the world are turning to debt markets to move faster. That can amplify returns, but it also amplifies risk. So today we're looking at the top 5 companies borrowing the most to fund AI and what that really means for investors. This ranking is based on publicly reported bond issuances, credit facilities, and financing tied directly to AI and cloud infrastructure. Not hype, not headlines, actual capital. Number 5, CoreWeave. CoreWeave is one of the clearest examples of how expensive AI really is. It rents high-performance compute, mostly GPUs, to companies building and running AI models. But growing this fast requires enormous upfront capital. So CoreWeave has leaned heavily on debt financing, including multi-billion-dollar note offerings and credit facilities. Here's the key investor insight. When a company's product is capital, leverage becomes unavoidable. If demand stays strong, debt magnifies equity returns. But if pricing weakens or utilization drops, leverage works in reverse. This makes CoreWeave less a traditional tech company and more a leveraged infrastructure play. Number 4, Amazon. Amazon doesn't borrow because it's under pressure, it borrows because it has options. As AI spending accelerates, Amazon has issued large bond deals to fund data centers, chips, and cloud expansion. Not because it lacks cash, but because debt preserves flexibility. Here's what investors often miss. For megacaps, borrowing is a capital allocation choice, not a survival tool. But even here, risk exists. If AI investments don't translate into higher cloud margins, markets can punish years of heavy spending, even if the company remains profitable. Amazon shows how AI debt isn't dangerous by default, but execution suddenly matters more. Number 3, Alphabet. Alphabet has long been known for one of the strongest balance sheets in corporate history. So when it returns to bond markets in size, investors should pay attention. Alphabet's AI push, from data centers to custom silicon, has pushed capital spending to new highs. Borrowing here isn't about necessity, it's about efficiency. But it sends a signal. Even companies swimming in cash believe the AI race requires scale, and scale requires financing discipline. For investors, this raises an important question. If even Alphabet is borrowing to fund AI, what happens to smaller players when credit conditions tighten? Number 2, Oracle. Oracle has aggressively repositioned itself as an AI and cloud infrastructure provider. And that shift has been financed in part with significant debt issuance. Oracle's situation is different from big tech. Its balance sheet already carries more leverage. So AI expansion pushes both opportunity and risk higher at the same time. This creates a split narrative. Equity investors focus on new AI contracts and revenue growth. Credit investors focus on debt levels, cash flow timing, and refinancing risk. Oracle is a reminder that AI investing isn't just about upside, it's about balance sheet tolerance. And markets don't always agree on how much leverage is acceptable. Number 1, Meta. Meta sits at the center of the AI spending boom. It has raised some of the largest corporate bond deals in recent years and committed tens of billions to data centers and AI infrastructure. What makes Meta number 1 isn't just the size of the borrowing, it's what that borrowing represents. Meta is a company with strong cash flow, choosing to lever up to accelerate AI development. That turns AI into a balance sheet bet. If AI drives engagement, advertising efficiency, and new products, leverage amplifies shareholder returns. If execution slips, debt magnifies downside. This is the uncomfortable truth. AI investing isn't just about believing in the technology. It's about believing in management's timing. This ranking won't satisfy everyone. Some investors will argue borrowing is rational. Capital is cheaper than missing the AI cycle. Others will see rising leverage as a warning sign. So here's the real question for investors. Which company is borrowing in the smartest way? And which one is taking a risk the market hasn't fully priced in?